the other thing that we're starting to get into is, the calculations within the provision itself. And as I think about that, I try to divide it into domestic versus international, because I think there's different complexities and certainly different issues associated with each. So why don't you share some thoughts maybe on the domestic side?
The biggest thing to consider is that beginning in 2018, there will be a change in the tax rate for corporations. And so previously, for example, you might have had a 35% rate. Beginning in 2018, it'll be 21%. And so what that means for a calendar year taxpayer, for example, would be that your current provision will be calculated based on current rates, so for example, 35%, and then your deferreds will need to be recognized or evaluated or measured at the 21% rate. Something to consider if you're not a calendar year filer would be that you have the potential to have a blended rate. So where it'll be based on the number of days in 2018 versus the number of days in 2017. Another consideration to consider from a domestic perspective is that in the current year, there is the opportunity to take 100% bonus depreciation on assets acquired and placed in service after September 27th, 2017. And so this is one of the provisions that starts currently. So you'll need to think about that as you're looking at your fixed assets.
Another thing we deal with a lot is considering whether or not a valuation allowance is necessary. And I know there's some changes related to net operating losses. Do you want to talk about that?
Yeah. So basically, under the new Tax Act, for NOLs generated in 2018, they will no longer be able to be carried back. They'll only have the ability to be carried forward. Previously, NOLs you had the ability to carry back 2 years and forward 20 years. Now, you cannot carry back, but you'll be able to carry forward indefinitely. Additionally, for 2018 generated NOLs, you'll only be able to offset 80% of taxable income. So these are just things that companies will have to consider.
Okay. When I think about the valuation allowance, what I'm hearing means that in some circumstances, I think the valuation allowance might be higher now under the new rules because of some of those limitations that were presented.
Yeah. So just things for companies to continue to consider.
Absolutely. So I think that was the easy part. What about the international side?
Yes, the international side has the potential to be the most complex area as companies are looking at their income tax provision. What we've shifted from is a worldwide system to a territorial system. And as a result of that, there will be a one-time transition tax. And what that means is that companies will need to look at their earnings and profits and calculate this transition tax, and it will be a currently tax payable item. This has the potential to be an incredibly complex calculation, and companies should get started on this as soon as possible.
Okay. How does that factor into a company's reinvestment assertions, like what you just described?
Yeah, so the rules, the GAAP rules behind reinvestment assertions haven't changed, but what has is the Tax Act. So companies should each year at financial statement dates be reevaluating whether they have permanent reinvestment assertions that they're making with their foreign subs. It becomes more important to do this as the system has changed and as companies might have different cash needs related to the toll tax or other items. But basically, the real message is that each year you should be evaluating these assertions, and the Tax Act will have a big impact on that.
That makes sense. With all of these changes, it seems like it's going to take tax provision preparers longer than in years past to prepare the provisions, just because they're understanding these new rules. So the SEC recently put out some guidance that would provide some relief in circumstances where a preparer doesn't have the information to do a complete analysis when their financial statements need to be issued. And their guidance is kind of based on whether or not you can provide a reasonable estimate as of that time that the financial statements are being issued. The FASB yesterday in that conversation I mentioned looked at that guidance and said they wouldn't object to a non-public company using that information, which I think will be helpful and provide some relief. one caveat is that companies should be using that guidance in good faith, and if they truly have the information available to complete the provision, they should be doing that. But this would be in those rare circumstances where they just can't get through everything, and given the complexities that you shared, that could be a possibility here.
Right, and it's just going to be an opportunity for the tax teams and the accounting side to really work together and come to the right answer for the financial statements.